It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hello everyone, welcome to Search for Yields, a weekly newsletter by INR Bonds. I am Nikhil, and in today's topic, I'm going to discuss with you about Indiabulls Housing Finance, skipping the call option and its implication on its bondholders and as well as the debt markets. As you must be aware from our latest bond bites, where we said that Indiabulls Housing Finance skipped call date on one of their perpetual bond. Before we dive into the topic, I would start with what are perpetual bonds and what are the riskiness of holding a perpetual bond. The perpetual bonds by itself, by the name, you can understand that the bonds which doesn't have the maturity date, and the coupons paid by the issuer are in perpetuity. However, these perpetual bonds, when they're issued, they come out with a call date, which is typically from 5 to 10 years from the date of issuance. So, whenever the call date comes, the issuers tend to call back the bonds, and the investors who invested in the bond in these bonds also expect the issuer to redeem the bonds on the first call date. However, these perpetual bonds carry more riskiness than compared to a normal debt. So, in a time of when a lender, when the time of a distress, or whenever the capital requirement mentioned by the regulator falls below the required level, they tend to write off this AT1 bonds or the perpetual bonds, or they convert the bonds into the equity. Clearly, in the past, we have seen during the time of S Bank fiasco, where RBI has written off, the S Bank has written off the perpetual bonds during the RBI restructure scheme. Not only in India, globally, there are instances when the perpetual bonds were not called off during the time of on call date. For example, the Deutsche Bank during the time of 2008 global financial crisis, the Deutsche Bank has skipped the first call date, and also the Standard Chartered Bank did the same. And 2019, the Spanish lender standards also did the same thing, didn't call the bonds on the first call date, which resulted in sharp movement in the prices. The prices fell as the yields rose by 100 to 200 basis points. And on the contrast note, if you see, there are few perpetual bonds which were issued 300 years ago and they're still continuing the interest payments, like the one the Dutch Water Authority Services issued a perpetual bond, which was the oldest perpetual bond, issued in 1648. They continue to pay interest to the bondholder. Coming to the Indiabulls, especially the Indiabulls Housing Finance skipping the call date, this bond was issued in 2012, which raised around 1 billion rupees, and with a coupon of 10.60. The first call date was set on 20th June 2022, which is 10 years from the date of issuance. However, on 28th of June 2022, the company chose to pay the interest payment and skip the call date, haven't redeemed the principal amount to the bondholders. So, what are the implications of such lenders skipping the call date, especially in particular to Indiabulls Housing Finance bondholders, where the bondholders would see a sharp fall in prices in the market, and if they have to sell the bond would trade very thinly and very liquid, which leads to the pricing risk. So if they have to sell the bond, the latest LTY shows that latest traded yield, it was traded at over and about 12%, but however it was issued at 10.60%. Clearly, the bondholder have to write off the losses, and if he gets a buyer, he has to incur the losses, and also he would have missed out on a lot of opportunities during the time frame if he's holding the bond in his books. And also coming to as a issuer, the Indiabulls Housing Finance would have skipped the current call option, as it would have been economical. It would have made sense economically for them to skip the call date instead of coming to the market and raise the funds at higher rate. Since the interest rate cycle changed, the rates are moving up. So it would have made economical sense for them. But however, in future, if they come out with any subordinate debt, market would definitely ask them for a extra premium, as the credibility in the market, they lost the credibility in the market as they skipped the call date. Coming to the debt market all over, the lenders, especially with the weak financials and who have issued the perps, would see some kind of rise in their fall in their prices and rise in yields. And also, if they come out with a fresh issue, the markets would demand a premium from them, given the weak lenders are skipping the call dates. And we could see some risk aversion, given that the issuers are skipping the call dates, and also the interest rate cycle is changing, and the central banks are sucking out the excess liquidity from the market to bring the normalization and bring down the inflation in the economy. So you can check out our Quick Invest by INR bonds, where we have curated list of bonds, and also mention the INR bonds risk score, which takes care of several factors like financial stability of the issuer, the credit spreads, and as well as the macroeconomic trends. So this will fairly give the investor the about the riskiness of the issuer, where he is investing into, and what is the kind of riskiness he can expect while investing in such particular issuer. Our app is available on both the Play Store and App Store. Do download it. And also, if you have not subscribed to our YouTube channel, please do so in order to get timely updates from us. Thank you for listening.